What's up everybody, GenExDividendInvestor here. Merry Christmas and Happy Holidays to all. In this video I'm going to compare some pros and cons of investing in dividend stocks versus life insurance versus annuities, since you can get dividends from life insurance and passive income from annuities. And if you don't want coal in your stocking, then please hit the thumbs up button, subscribe if you haven't yet, and click that bell notification. Note, I'm not a professional wealth manager, so don't take what I say as good financial advice, though you can take it as mediocre advice. Now, I get finance and investing questions all the time, with the common thread being about retiring, so let me share some data which will be useful for you when thinking about dividend stocks and annuities and such. So, retirement income in the USA is often thought to come from three sources. Number 1, Social Security, number 2, pensions, and number 3, savings and investments. In 2019, 84% of people in the US that were 65 or older got Social Security. The average Social Security payout was around $18,000 a year for a single person, or about $31,000 a year for a household with 2 retirees in it. We also see that 68% of people 65 or older got income from assets, though the median income from assets was only around $1,900 a year. Assets are checking and savings accounts, CDs, stocks and dividends and bonds, real estate related income, royalties, and stuff like that. Then we see that 31% of older folks got income from a pension plan or an annuity. An annuity is just a financial product provided by an insurance company meant to give you a guaranteed passive income stream. The median annual income that people got from private pensions or annuities was about $11,000 a year. It was about $28,000 a year for federal pensions, $23,000 a year for state or local pensions, $17,000 for railroad pensions, and $22,000 a year for military pensions. Then we see that 24% of people 65 and older got income from earnings, aka a job or a side hustle. The median amount of earnings from those jobs for 65 plus year olds was $35,000 a year, and for 75 plus year olds was $26,000 a year. And then a small percentage of retirees got income from veteran benefits or public assistance, or effectively had no income. This shows us that 40% of people aged 60 and older only got Social Security income. Then 15.4% had defined benefit income, aka pension income, as well as Social Security income. And then another 15.1% had defined contribution income, aka 401ks and 403b retirement accounts, as well as had Social Security. Then 14.9% unfortunately had none of those sources of income. 6.8% had pensions, retirement accounts, and Social Security. 3.8% had pension plans only. 2.5% of people only had retirement accounts, and then 1.3% of people 60 and older have a pension plan and a retirement plan, but no Social Security. Okay, if you're watching one of my videos, then I'm assuming you're familiar with dividends, but what about life insurance or annuities? How can they generate wealth for you as compared to dividends? Well, the TLDR is that life insurance isn't primarily about you, it's an investment you're making for the people you would want to take care of when you die. Annuities, on the other hand, are an investment which gives you a lifetime guaranteed passive income stream. Both products are often marked as tax-deferred alternatives to traditional stock and bond investments. They each have relatively high expenses that can lower your investment returns as compared to dividends. So let's dive into life insurance for a moment. You usually get life insurance to help your beneficiaries with money for when you're gone. Maybe you are a key income provider for the family. Maybe they need money for things like your funeral, or for college, or for some expensive Tinder dates in Vegas. Hey, if it bothers you thinking that your nest egg is going to be spent on dating, then remember that I'm here for you and you can always leave everything you own to Gen X. You're welcome. Anyways, I did a video called The Time I Sold All My Stocks where I talked about some health issues I went through. One thing I didn't mention was that I looked into getting more life insurance before the risky surgery I needed to do. I had some life insurance through my job, and I thought my family would be financially fine due to our dividends and such, but I still looked into getting more insurance. But of course I found out that you don't want to be shopping for life insurance right before you go into a big surgery. Which kind of makes sense as the life insurance company wants to make money on you, so the younger and healthier you are, the easier it is to get covered and the better your future payout can be. I did find an option called Guaranteed Issue Life Insurance that didn't need to check my medical history, but it didn't seem worth getting. Sidebar, leave me a comment if you ever got screwed over by your insurance. I recently called up my insurance to see if they would cover a leaky roof, but of course it was excluded. I'm actually long in an insurance stock because I figure if you can't beat them, then join them. Okay, there are two main types of life insurance. Number 1, term life insurance, and number 2, permanent whole life insurance. Term is the simplest form of life insurance, and it pays out if death occurs during the term of the policy, which is usually from 10 to 30 years, at which point you can often renew with new terms and fees. Permanent life insurance pays a death benefit when you die, so it has no set period of time other than your full life. Unlike term, it's not a pure life insurance product because it includes a cash value component. A policy has cash value when a portion of your premium dollars are invested and the sum grows over time on a tax-deferred basis, so you don't pay taxes on the gains. Not only that, but many whole life insurance policies provide dividends that are paid to policyholders. The dividend amount often depends on the amount of the money paid into the policy. For instance, a policy worth $100,000 that offers a 3% dividend will pay a policyholder $3,000 for the year. If the policyholder contributes another $3,000 in value during the subsequent year, they will receive $90 more for a total of $3,090 next year. These amounts can increase over time to sufficient levels to offset some costs associated with the premium payments. Another interesting thing about those dividends is that they generally aren't subject to taxes since the insurance companies generated the gains off of their policyholders. Thus, dividends received from a life insurance policy are treated as a distribution from the contract and are distributed income tax-free until the taxpayer's investment in the contract has been reduced to zero. So basically, the dividend payments are treated as refunds for overpayment of the premium. Some policies allow you to access some of the funds from your death benefits if you develop a chronic illness. You can also sometimes take loans against the cash value of your policy, kind of like how you can take loans against your dividend portfolio. And don't do anything extreme like take a loan out and then use that to invest. I've seen too many people get burned doing that, so ignore the TikToks that are telling you it's a good idea. Anyway, you can also use a perm life policy to set up an irrevocable life insurance trust to protect your beneficiaries from estate taxes, since that sort of trust is not considered to be part of your estate. Some policies give you a minimum amount of return regardless of how the stock market performs, and the returns you make within a life insurance policy are basically not subject to taxes. So some people who max out their IRAs and 401ks and decide that they want to find even more tax-sheltered vehicles for their retirement income might choose to invest in a life insurance permanent policy. It's also good to know that you may be able to convert your life insurance into a long-term care benefit plan, and you may be able to convert your life insurance into an annuity using a 1035 exchange. So my 2 cents is that you probably should get life insurance if you get married or have kids so you can provide for your family after you're gone. I would focus the far majority of my investable dollars into quality companies in my portfolio. Okay, let's move on to annuities now. Annuities are a financial vehicle you invest in to get a guaranteed income stream while you're still alive. When I hear guaranteed income, I think of pensions and Social Security, though the reality is nothing is truly guaranteed. I want to put all my eggs in any one basket, regardless if they called it guaranteed or not. Annuities aren't insured by the federal government, but there are guarantee associations that cover up to a certain amount of your investment if the insurance company that issued the annuity goes bankrupt or whatever. Dividend income isn't guaranteed, of course, so that's a pro for annuities. You can contribute a lump sum into an annuity, or you can make payments over time into them, and your earnings can grow tax-deferred. Annuities tend to be longer-term contracts, like 3 to 20 plus years in length, and like most contracts there are penalties if you break them. So if you take money out of an annuity, then you may face a penalty fee. Annuity contracts have those fees in place in order to make up for the insurance company's loss if you choose to withdraw before they can earn interest on your principal. Okay, there are 2 time frames for annuities, deferred and immediate. Immediate annuities are designed to provide a guaranteed lifetime recurring income starting basically as soon as you get one. A deferred annuity promises to pay the owner a regular income, or lump sum, at some future date. You pay a lump sum or monthly premiums to the insurer, who will then invest it into one of 3 growth types, i.e. fixed, variable, or index. Now, depending on the investment type you choose, deferred annuities offer potential for the principal to grow before receiving payments. Deferred annuities are an option if you want to contribute to your retirement income on a tax-deferred basis, meaning you won't have to pay taxes until you take money out. Unlike IRAs and 401ks, there are no contribution limits. Fixed annuities are the simplest type of annuity to understand. The insurance company gives you a guaranteed fixed interest rate on your investment based on a period of time. Fixed immediate annuity income payments are pegged to the amount you contribute, your age, and the interest rate at the time you purchase. Those payments to you will not go up or down, thus are not impacted by market volatility, nor will you benefit from upswings in the market, so it might not keep pace with inflation. With the variable payout annuity, the amount of income you'll receive depends on the performance of your portfolio or underlying investments, usually stock and bond mutual funds. This means your payment will vary each month, or it might change at least once a year, depending on how the annuity is structured. When your contract is over, you can either annuitize your contract, renew your contract, or transfer your money into another annuity contract or retirement account. An inflation-indexed immediate annuity is similar to a fixed annuity. You receive a guaranteed stream of income from the insurance company for the rest of your life. The difference is that the payments increase or decrease each year, keeping pace with the rate of inflation. Indexed annuities pay you based on the performance of market indexes like the S&P 500 or whatever. You aren't directly investing in the stock market with an index annuity. The market is just used to determine how much compound interest your annuity gets each year. All gains earned in a fixed index annuity are locked in and basically can't be lost in a down market. Once you earn the compound interest, it's yours to keep. But indexed annuities can limit how much you earn, even in strong market years. That's why some people say indexed annuities are less risky than investing directly in the stock market, but also offer smaller potential gains. Compare those types of annuities to dividends, where your payments may fluctuate up or down based on hikes or cuts or suspensions, or based on currency fluctuations if you're investing internationally. That being said, good dividend companies tend to keep increasing their payments. For some immediate annuities, the insurance company keeps the principal when the owner dies. However, there are refund options or periods, and a beneficiary can receive any remaining payments. Lots of things to research. Some annuities can be set up to also give your spouse income as long as they're alive. You typically use after-tax dollars when investing in an annuity, and any earnings often grow tax-deferred. Some annuity plans function kind of like a company's 401k match, where your contributions can have some sort of bonus match. For example, if you invested $100,000 into your annuity that had a 7% bonus match, then you actually end up getting $107,000 added to your account. You can roll over qualified variable annuities, i.e. those established with pre-tax dollars, into a traditional IRA. Qualified annuities are often set up by employers on behalf of their employees as part of a retirement plan. Annuities have various terms associated with them, like how many years they pay out for, though you can find ones that pay out for your entire life plus the lifetime of a beneficiary. That might be compelling if you are worried about the beneficiary's ability to manage money. Now, when you start receiving payments from your annuity, you enter the annuitization phase and your money might not grow anymore. Here's a table I found online comparing the various types of annuities. Feel free to snapshot it if you're researching them. If I had dividends on this list, I'd say that they don't really have principal protection outside of options. You have access to your principal, though they could be constrained if your dividends are in retirement accounts. You have control over your money with dividends. You have tax-deferred growth with dividends if you hold them in retirement accounts. You don't have guaranteed growth, nor guaranteed income. You kind of have inflation protection with your dividend hikes, though it's not a guarantee. And you kind of have a death benefit with dividends in the sense that your beneficiaries can inherit them. If you're curious how much money gives you a guaranteed income stream, then you can find Annuity Calculators online. An example I saw was that if you invested $100,000 into an annuity, it would pay you $479 per month for the rest of your life if you purchased it at age 65 and began your payments immediately. That's effectively a 5.75% yield. So not too impressive, but it's guaranteed. If you are interested in annuities, then check out Fidelity, which has various ones they offer with minimum investment amounts and fees. One downside of annuities are fees, because something that guarantees you income won't be free. Another drawback of annuities is that you're often trading liquidity of principal for guaranteed income. But if securing lifetime income is your main goal and you can't comprehend dividends, then a lifetime immediate annuity could be good for you. The annuity payments you get typically include some profit plus some of your principal, so it's kind of return on capital. I personally prefer the control, principal access, no fees, current dividend income, and future increasing income potential for dividends over annuities, but there are times that annuities make sense. So when would I recommend an annuity? Well, if I was someone who didn't know about dividends and didn't want to learn about them, or didn't have the mental capacity to learn about them, or if I wanted a third party to more directly manage my income, then annuities might be compelling. I know a lady whose husband left her after being married for 3 decades, and he had been the sole breadwinner. She ended up getting a good amount of their assets when they divorced, which included a large chunk of cash along with some real estate, and alimony payments. But she had no financial literacy and sold assets and then put the cash in the bank and didn't invest a dime. She kept spending money like when they were married, and she eventually ran out of all her cash once the alimony stopped and all her assets were sold. She was clueless about stocks and honestly probably wouldn't have fared well with investing in dividends on her own. So for her, an annuity would have been awesome. I think if you're in poor health and think you might not live for many years, then an income annuity probably isn't an optimal investment solution. If you are considering dropping a lump sum into an annuity, then you want to make sure that you still have enough savings to cover unexpected expenses beyond the income your annuity would provide. Here's a summary table I found you could screenshot that compares annuities to life insurance. And here's another table I found comparing life insurance to annuities for those of you that are seriously exploring them. Hopefully now you have a better idea of when life insurance makes sense, when dividends are better, and when annuities might make sense. They each can play an important role in your future and your beneficiary's future, depending on your needs, risk tolerances, and goals. The key thing is to take control of your money and your future by learning about finances and then executing on what you learn. Live frugally and invest appropriately, and in the long run you'll be happy. Educating yourself and rubbing shoulders with other good investors will increase your likelihood of financial success. So I recommend that everyone join my free Dividend Discord chat server, which has thousands of investors on it from around the world. Okay, now I'd like to shout out my latest Patreon aristocrat who just signed up. So thank you, Buodon. Aristocrats gain access to my Dividend Portfolio Tracker spreadsheet, along with access to multiple private channels on my Dividend Discord, including one where I let people watch my videos before I release them to the public, as well as I often let them vote on which thumbnails I use for my new videos. Finally, if you appreciate free videos like this and you aren't the Grinch, then please hit the thumbs up button, subscribe if you haven't yet, and click that bell notification. I hope you have a Merry Christmas and Happy Holidays, and I'll talk to you again real soon. I am not a financial advisor, and these videos are for entertainment, inspiration, and educational purposes only. Investing of any kind involves risk. I am only sharing my opinion with no guarantee of gains or losses on investments.